Here's what I think is going to happen. You're going to have at some point around, say, let's just say June. Don't hold me to that date because it could be July, it could be August, it could be May. I don't know. May, maybe. So what you're going to see is you're going to see the peak of growth and inflation around that time. And then you're going to see what is going to be a massive fiscal and monetary cliff occurring. So I'm predicting a super spike in interest rates because along with that growth and inflation, you're going to see the 10-year note yield approach 2%. 2%. That's going to scare the stock market. You might see an absolute plunge in stock prices around that time. And that fear is going to come exactly at the same time that there'll be no more trillions of dollars in fiscal stimulus.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty and Finance. We have a returning guest that our viewers are always appreciative to hear from. This is Michael Pento. He's the founder of Pento Portfolio Strategies. He joins us this Monday, February 8th, 2021. Mike, thanks for coming back on.
Well, I shoveled all the snow out of my driveway. I made it in. So
the East Coast has gotten clobbered over this past weekend. We're glad that people have been making through as best as they can, and glad for your presence here with us.
Thank you. We're rooting for global warming. Just kidding.
Yeah, we always say blame it on global warming when we get record cold. So anyway, wanted first to get your quick update. People have been noticing over the past week, goodness gracious, that we've had this, for various factors, including the Reddit crowd swarming on silver and that perhaps putting some pressure on what was already a pressurized situation there. But people have been really concerned about the stability of the banking system, the major factors that you watch as you're a money manager taking care of people's funds. People are concerned about their own investments, their own retirement, their own moves that they should be making. And you've often weighed in with us through the months and through the years on what your timeline is that you're looking at, or what major factors you're looking at that are driving you to make certain moves on behalf of your clients. So if you could just maybe start with that macro picture of what you see us traveling through right now in terms of some of the major forces that are affecting our investment lives. And then we have some specific viewers' questions we can hit in the short time we have.
Okay. That's a great first question, Donegan. All right. Let's see if we could, as they say, unpack that one step at a time. First of all, of course, investors should be very concerned. I mean, look what's going on in the casino that's become the stock market. And I guess when you print $1.44 trillion in 1 year. This is the minimum that the Fed has announced that they're going to print. $1.44 trillion in 2021. So the money has to go somewhere, and it's going to, the Reddit boys, the Robinhood boys. It's going to Tesla. It's going to, EVs. It's going to, just any kind of thing you can think of, any kind of Bitcoin, and it's just crazy. So you should be very concerned when the total market cap of GDP hits 200% of the underlying economy. That's where we are now. It is light years ahead of where it should be. The average of that ratio should be around 0.6, and we're twofold of the underlying economy. So yes, you should be very concerned. So I'm long the stock market right now. I've sold almost all of my gold. Cover your ears. I've sold almost all my gold temporarily, and I'm going to explain to you why it is temporary and why I think we're going to go heavily into the metals in late spring early summer. But let's just go back to why I didn't panic a few weeks ago, why I have all longs, no shorts, and almost no gold in the portfolio. And the reason is that I have a 20-point model called the inflation deflation economic cycle model. So when the headlines come out and say, okay, so the Reddit boys are attacking the silver market shorts, and they're attacking GameStop shorts and American Airlines shorts, and these stocks are surging by thousands of percentage points in a matter of days, and major institutions could be blowing up, major hedge funds could be blowing up. That's what the headlines all said, not me. CNBC even did a report about headlines suffering billions and billions of dollars in losses. And the rumor was this was going to bring down Wall Street. I read them. You read them. Okay. So, Michael, why didn't you panic? You asked. You did ask that question. The reason why I didn't panic is because of the model that I have. I look at the internal components of the market like a scientist would, things that are more arcane than just like moving averages. So I look at LIBOR OIS spreads. I look at high yield spreads. I look at break-even spreads. I look at the shape of the treasury curve, just to name a few. And everything was quiescent. Everything told me there's really nothing to worry about in the short term. Yes, there is a lot to worry about going down the road here in the next few months. But right now, there was nothing to worry about. So I kept my longs. I didn't take any short positions. And here we are at all-time highs in the portfolio and all-time highs in the market. Now, you wanted me to walk through where I think we're going in the near future. So why did you say, Mr. Pento, why did you sell your gold? Okay. So I sold the gold most of the gold, all the miners, and most of the physical gold last year in the fall. And I called it the vaccine dead zone. I said, watch out when these vaccines start getting approved, you're going to get a sell-off in the gold market. It's exactly what occurred. And now you're heading into the teeth of the major pressure in the gold market. Now, I will mention that Elon Musk talked about not only buying Bitcoin and some other Doge coins or whatever coins, he also mentioned today that he's been buying gold, which caused gold to surge today. Even though, you look at the dollar dollar is rising against the euro, and nominal treasury yields are spiking. Both those things should be very bearish for gold. So this might be a good day. Again, cover your ears, Dunnigan. This might be a good day to sell gold if you are a short-term trader. Now, going into the teeth of the problems with the precious metal market is going to be April, May, and maybe a little bit of June. And the reason why is because while gold likes inflation and gold likes disinflation, both those things are true, what gold hates is rising real interest rates. And if you have inflation combined with growth at the same time, so growth, the second derivative, the rate of change of growth and inflation are rising simultaneously, it is horrible for gold. And maybe there'll be some mollifying or assuaging characteristics about it this time because of the amount of debt that we're also adding to the economy. We look at, we did $4 trillion last year. The ink isn't dry on the $900 billion that was signed late December. Now we're going to add $1.9 trillion probably in the next couple of weeks. And then, Dunnigan, probably in March, you're going to look at the stimulus package for infrastructure going to get passed. Or at least there'll be a lot of talk about it at that time. So you're going to see growth and inflation accelerating off of that very low base that we saw in April and May of last year. That's going to send a lot of headwinds into the gold market. But then the skies part, that might be a great time to buy at the nadir, at least of a cyclical or maybe even a secular nadir in prices in the precious metal market, because I think they absolutely skyrocket later on in 2021.
On the flip side of this, the equities side, we have a question from Psycho Stacker who says, what quarter, and rather than the date, maybe you're going to talk about the factors or the trends or whatever, what quarter are you expecting a sell-off in equities and how are you preparing for it? What signs should we keep our eye on?
Okay, so I never the reason why I don't tell you that this is going to happen this date is because only God knows. Believe me, I'm very far from Him with a capital H. I will tell you this. I'm like you said perfectly. I'm monitoring all of the factors surrounding what could happen in the model. So to be specific, I believe in the second half of 2021, you're going to see the rate of change in growth and inflation slowing. And a lot of that is predicated upon what happens with the vaccines and the virus. Okay? I am assuming that the virus, the rate of infections and deaths slows dramatically into the summer, and then it plateaus. So I think we'll be living with this virus and the variations, the mutations of this virus for many, many years. I think it's going to be like the flu. That's my base case scenario, based upon all of what I've read. I'm not a virologist, epidemiologist, as you know. But from all I've read and understand, this is going to be like a very serious flu that we'll need to get inoculated against every year. Some people will, and some people won't. Many, many people will not get this vaccine. So if you don't reach herd immunity, then you're going to be living with this virus for many, many years to come. But it's that rate of change in growth and inflation. So this is what I see happening, which could be very bullish for gold and very bearish for stocks in the second half of 2021. And again, you cannot push me for a date or a time. I'll know it because my model, like you said, what factors will you look at? I will look at the shape of the yield curve. I'll look at high yield and LIBOR OIS spreads. I'll look at break-even spreads. I'll look at the MOVE index, which is the volatility index of bonds. I look at all these things. I have a 20-point model. But here's what I think is going to happen. You're going to have at some point around, let's just say June. Don't hold me to that date because it could be July, it could be August, it could be May. I don't know. May, maybe. So what you're going to see is you're going to see the peak of growth and inflation around that time. And then you're going to see what is going to be a massive fiscal and monetary cliff occurring. So I'm predicting a super spike in interest rates because along with that growth and inflation, you're going to see the 10-year note yield approach 2%. 2%. That's going to scare the stock market. You might see an absolute plunge in stock prices around that time. And that fear is going to come exactly at the same time that there'll be no more trillions of dollars in fiscal stimulus. Remember, the construct of DC is 50-50 in the Senate. They can't lose, Democrats cannot lose one senator. And Joe Manchin from West Virginia is not going to pass trillions upon trillions upon trillions of dollars after this infrastructure deal is done. So we had $4 trillion in 2020 passed in fiscal stimulus. I'll put that in a quote, stimulus. We have $2 trillion passed now in the next few weeks, and then there'll be another whatever in infrastructure package, and that's it. So you're going to have an economy that's going to be existing on its own gas without fiscal stimulus and without monetary stimulus, because at that time, when we hit 2%, 2.5% inflation, and the economy is roaring, and the vaccines have started to kick in, and you'll see maybe an attenuation in the rate of cases and deaths and hospitalizations. You'll see the Fed, at least Wall Street, will be worried about the Fed starting to taper, and they'll be tapering $120 billion a month minimum down to zero. That's the trajectory of the tapering. And if you remember, last time the Fed tapered in 2013, it didn't work out well for bonds and it didn't work out well for stocks. But this time around, and I wrote a commentary about it, you can find on my website. This time around, tapering is 120 billion. Their last tapering occurred from 85 billion. It's almost 50% more in the amount of QE that has to be tapered. Plus, when you look at the amount of debt outstanding and the market cap of GDP, the overpriced state of the market, tapering is any kind of tapering. Even the fear of tapering this time will be much more devastating than last time. I don't want to be anywhere near the stock market when that happens. So second half of this year, when everybody's telling you, if you listen to Wall Street, Don, again, everybody says, we are going to have growth rates surging in 2021, especially once the vaccines take hold. I have the opposite view. I think that the rate of growth or inflation is going to slow because of base effects and because of the fiscal and monetary cliff. And that means watch out. Watch out for stocks, and you better own some precious metals. And you know what? You can open your ears now. I believe that the coming few months, so figure around April, May, will offer a great entry point for those to increase their positions in precious metals and for those who sold to get back in.
You may have already answered this one, but there's a follow-up question that's related to a factor that you were describing there about the spike in Treasury yield. H. Paul Fuchs says, how would you describe the changes in the 10-year Treasury note and the Dixie as harbingers of, quote, the big one, an implosion of all debt and equity assets, not just a simple correction?
So I listen, that's coming. There's going to be an absolute implosion. But it will be when inflation runs so intractable that the Fed gives up, not only the Fed, but all central banks give up the belief that they can have fiat currencies predicated on nothing, based on nothing, backed by nothing. We're a long way away from that. So that's the final blow up. You don't need to have the ultimate crash to get a really good opportunity to short sell stocks here, because you remember in 2000 the S&P lost half of its value. In 2008 it lost half of its value. In 2018 the Russell lost 30% of its value. In 2020 we lost 30% of the value of stocks in a matter of weeks. I think this coming crash will be devastating because, and maybe to this person's point, if I'm correct, and again I could be completely wrong, and I won't short anything. I'll stay long. I rely on the internals of my model that I built to tell me when or if to act. But listen, if the market starts going down 50%, 80%, could be a possibility. That's what happened between 2000 and 2002 in the NASDAQ, and it wasn't even as overvalued as the market is today. Those other occasions, the dot-com bubble bursting and the real estate bubble, and even 2020, the Fed had some room to lower interest rates. I mean, we were at 1.75% on the Fed funds rate at the start of 2020. We're at zero now. We are at zero now, not at 5% like we were, or 6% in 2000 and 2000. We were 5.25% in 2007. We're at zero now, and we're at $120 billion a month in QE. So if we have a market dislocation, if the market crashes because yields are spiking intractably as the rate of growth and inflation are accelerating, what is the Fed going to do? Are they going to lower interest rates? Well, they cannot. Are they going to increase QE? Well, yeah, but so what? I mean, who really cares? I don't think they're going to be able to arrest the decline in stocks simply by increasing QE or by lowering interest rates, because there's no room to lower them. They're not going to go negative, and even if they did go negative, that doesn't help. Look what happened in Europe, in Japan. There's no help there in going negative. You just destroy the banking industry.
We have a question related to this, how it plays out in some of the other markets. Ring That Bell 2094 says, inflation question. 1 year charts on copper, nickel, zinc, and lead all show significant price increases. When will that increase start to be passed through from producers to consumers? A dropping dollar, upward pressure on bond rates, all the while stock market hitting all-time highs. Feels like a cliff awaiting us or a brick wall. Your thoughts?
Yeah, well, I mean, I was watching Bloomberg this morning, and somebody was talking about what they're waiting to see when inflation starts to become manifest. I mean, what are you talking about? I mean, has anybody out there in their audience looked at buying a house recently? Look at the price of homes. Even go to the grocery store. Prices are spiking in the grocery store as well. I mean, go buy some meat or some corn. Anything corn. Corn is in everything. Corn prices have surged. So it's coming, Dunnigan. It's here. It's coming. In April and May, it'll really be here, especially as they announce their CPI and PCI metrics that the Fed loves to talk about. But more to your point, more to the questioner's point, when you get another round of, you have I think we're having $2,000 in checks being mailed out shortly, right? 600 plus the 1,400. So 600 was passed in December, 1,400 more. That's $2,000. That's money going directly to consumers who have the propensity to spend the money. So you're going to get CPI really going in the late spring, early summer. And that's why I see the super spike in interest rates. And that's why I don't want to be anywhere near the stock market at that time. And when I say nowhere near the stock market, I'll be buying things that go up when bond yields surge.
Yeah. On the other markets, like real estate you just mentioned in passing there, Andrew McCulloch asks, would you say it's okay to buy a family home? I understand not buying an investment property for, in one case, bringing home the Schiller Home Index, but it's a personal home. Would you wait or buy now? So I know you don't give personalized financial advice. We don't either. But people who are watching, as you described, a swelling prices in the real estate market are wondering whether they should hold off and even going for a home at this point if they're talking about entering the housing market. Any factors that they should be aware of there?
So here's the thing. If I'm correct in my assumptions, you're not going to get any real rise in the Fed funds rate for many years to come. And that's going to be a big tailwind to real estate. Now, if you were asking me, and again, like you said very well, I cannot give personal advice. I haven't done any kind of due diligence on anybody. I don't even know their name. I can tell you, for me personally, if you could wait to buy a house, if you were going to buy a house and you could wait till June to do it instead of doing it today, I would wait. But after that, real estate, not investment properties, a home, especially in this era, this multi-decade era of very low interest rates, I would buy real estate, yes. Especially as a primary residence. I would not rent.
So we have time for one more question here from Donald Orphy Jr. We've talked so much through the years of why the U.S. dollar as the world reserve currency is in jeopardy. There's been official talk from the BIS and other groups, the World Economic Forum and others have been talking about that. But back at the ordinary person level, what Donald Orphy Jr. asks, what are the benefits for the average person of having the world reserve currency as their currency?
Well, it's a great question. So, I, unlike those in government, I actually love when my dollar goes up in price. Who wouldn't want to have their purchasing power increase? I mean, does anybody get really excited saying, oh, the dollars I worked so hard for buys me less? I mean, I never understood that. We can go around the world shopping at deep discounts when we have an appreciating currency. Our standard of living goes up. It's defined. Part of this definition of a higher standard of living is an increased purchasing power of your currency. So, I mean, it to me, it's this Keynesian world, liberal Keynesian world that says, we love inflation and we love a weak currency so we could somehow balance a trade deficit. Well, the dollar has crashed many times cyclically in our history since Bretton Woods was instituted, and the trade deficit goes up and away, even under Donald Trump, who actually had the courage to challenge China, and he was a big proponent of a weak currency. We had record trade deficits with China, so I mean, I just don't understand the rationale. The idea that you could balance your trade deficits by weakening your currency has never worked before in history, and it's not going to work in the future. If you want to balance your trade deficit, you have to produce more. You have to have stable monetary regime, so low taxes, low interest rates, low inflation, a strong and stable currency. That gets you prosperity, and that gets you a higher standard of living, not inflation, and certainly not destroying your purchasing power by destroying your currency.
Of all those factors that you mentioned there, the only one we have is low interest rates currently. Everything else we don't have.
Correct, Oswami. But those interest rates are absolutely artificially engendered. You know that better than anybody. So when you have artificially engendered interest rates, and that means you have massive asset bubbles, which will break, and then you'll get a rise in the dollar. But you won't like the results of that. When you talk about a meltdown in the bond market, stock market, and real estate market happening concurrently, possibly in late spring, early summer, it's not going to make many people happy. Well, that's why I'm in this position. I actively trade. I do my best to ride bubbles when they exist, but I also protect and try to protect and profit from these very healthy reconciliations whenever they come along. And we need one. we need one, and it's coming. And for most people, it's not going to be a happy time.
So how can people get connected with you if they want to get your assistance at either the insight that will help them be more aware of what's going on, or the actual active management that will help them to be on the right side of those resets when they happen?
First of all, I want to thank you for having me on the program. It's like, I've been banned from CNBC for the most part. Bloomberg, Fox doesn't want me on anymore. So thank you, for your outlet. Your platform is a great way to get my thoughts. So continue watching, Reluctant Preppers, and in particular Dunnigan Kaiser. But you can come to my website. It's pentoport.com. You can register for a trial subscription of my midweek reality check, which gives you a lot of my thoughts. You could also email me directly at mpento@pentoport.com if you have any questions. If you have around $100,000, I'll take you in as a client. And the office number here is 732-772-9500. Someone will take your call and schedule an appointment to speak with me. It's very important that you look to just remove yourself of the mindset that you can be a safe investor by buying and holding and dollar cost averaging in the stock market. It might have been true. It was true in the 60s, maybe the 80s and part of the 90s. But now when you have everything artificially engendered, from interest rates to asset prices to untenable debt loads, you have to actively manage your portfolio if you want to have a sound, prosperous, and safe retirement.
Michael Pento from pentoport.com, Pento Portfolio Strategies. Thanks for joining us. And folks, we are not immune from our boat being scuttled either, so also find us on Rumble and on Brighteon as well. Look for you there. Michael, thank you for joining us here again on Liberty and Finance.
Thank you again, Dunnigan.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.